Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant with me, my colleagues Reema and Nigel. Guys, good morning.
Hi, morning.
Hi, good morning. So much to talk about, right? There's things happening on the tech side with OpenAI and big numbers expected later this week. On the OPEC front with UAE looking to step back. Yeah. We've got, just counting down the month of April earnings.
Yeah, well, that's right. We start off a new series today. And plenty of cues. I think we'll have the state election results as well, and we'll get some indication later this evening as well. So, a lot of cues. Global geopolitics will be in center stage. Crude oil prices, state elections, earnings, you name it.
Well, April was actually great for markets.
Very good.
May, let's see. It's going to be hot. That is one thing we know for sure. But I don't know what else.
We want a red hot market.
And, let's just take it from the top then, right? In terms of where we are at, oil prices are about $110, $111 a barrel, which is Brent, which is what we're looking at. And there's not too much respite. I mean, the morning it looked like maybe slightly downward shift, but not really. So between $110 and $111 odd dollars. So President Trump posted on Truth Social yesterday essentially saying that Iran has told them that, they're in a terrible situation and they need to sort out who their leader is and how they're requesting the U.S. to open the naval blockade and open up the Strait of Hormuz, etc., etc. Well, and we spoke about this yesterday around the same time that every time oil prices will go higher, and by the way, gasoline prices, pump prices in the U.S. are back to the highest level, which is about $4.20 since the beginning of the war, 2 months back. So every time prices will go up, you will hear sound bites and statements from President Trump trying to smooth things out. The flicker of hope is what, you can call it. The expectation that something good will happen, that this will all go away very quickly, etc., etc. By the way, check out, there's a Wall Street Journal story this morning, which kind of, in a way, says the opposite. It says, and also it's a sourced story, but it basically says that President Trump has told his aides, his sort of team, that prepare for a longer blockade, naval blockade. So, the stalemate, ceasefire, whatever you want to call it. But basically the end result of all of this is that the strait is still closed and perhaps that isn't changing unless it changes. So we don't know exactly, right? At this point in time, there's no indication something is imminent. And that's the problem. Now, the other big piece of news which came through yesterday evening around 5:36 is the fact that UAE is going to leave the OPEC grouping, OPEC and OPEC Plus, next month after almost 6 decades being part of OPEC. Now, UAE is not a small producer of oil. It's got about 5 million barrels of oil in terms of capacity. And by the way, it's a country which has got 5 million, but it wants to do a lot more. So with OPEC, basically what was happening, of course, is that it was because of the quotas and, supply being limited. The directive from the top, and of course, it's the most powerful member is Saudi Arabia, because they wanted to maintain global oil prices at a certain level, each member country was given a quota. So the expectation is that UAE, which of course is suffering because of the war, its economic situation is not all that great. It wants to sell a lot more and not be bound down by what OPEC directives are, which means, for all of us, the global markets, etc., more oil eventually, hopefully, out there in the market, which means lower prices. But, the precondition for all of this, of course, is the strait has to open, and then we perhaps will see some of this come through. All right, well, just a quick bit on U.S. markets, a bit of a pullback. NASDAQ was down about 0.9%. And this is the thing. Yesterday, actually, the story came up, again, Wall Street Journal, reporting that OpenAI has failed to meet its own targets for new users and revenue. And I think that basically took a bite out of the large tech stocks out of in the US. By the way, OpenAI has come out and disputed the story and saying, well, they're growing very well across and firing on all cylinders, et cetera, et cetera. But I think this was basically the one thing which kind of the market kind of fixated on. Remember, these are all companies which are planning large IPOs in 2026. Oracle was down 4%, Nvidia was down about 2%. Talking about large cap tech, Google, Microsoft, Amazon, Meta will all report numbers tonight. By the way, there's also the Fed decision, which we will react to tomorrow morning. Apple will report, by the way, on Thursday as well. So, I mean, even in terms of global stuff, there is a fair bit. Second and final phase of polling, 142 seats in the fray in West Bengal, which is, of course, what the market is fixated on. And as always, later, after the polling ends, we hopefully will get some exit poll numbers, and we'll see, what people are, which way people have voted. Of course, I mean, it's not the last word. These are just polls in that sense, as the word suggests. We'll have to wait for the 4th to get the final result. Nifty, of course, is trading in a very, very narrow range. So, in that sense, if you want guideposts on the upside and lows, on the lower side, it's the immediate highs and lows. So, for the Nifty, the low of 23,883 is the support. 23,550 after that on the downside, and 24,300, which is where we've gone multiple times. We've crossed it once, and then, of course, we're back under it. So those are levels to work with. Gift Nifty will give you a quick sense of where we elected to start. We'll pick it up from there. So it's a neither here nor there kind of start, about 40 points higher. Nigel has walked across to the wall with the F&O positioning. Nigel, over to you.
Well, we kickstart the May series, and we're coming off a very, very super April 2026 series. There was a big outperformance, particularly from the broader market. So the Nifty went home with a gain of around 7.5%. But as the chart is telling you, we're starting off, we had a big outperformance that came in from the broader markets as well. The rollover pictures, the Nifty rollovers were close to around 71% or thereabouts. That's more or less in line with what you've seen in the previous 3 series. The Nifty open interest, though, is much lighter if you compare it at the start of, at the start of May in comparison to what we saw in April, though it's more or less in line with what we saw at the start of the March series. The roll cost, though, that's much lower. That's indicating short rolls, so you'll have to keep that in mind. The shorts are getting rolled forward into the May series as well. And if you look at positioning, well, in percentage terms, it doesn't look like too much of a difference from the FI basket in terms of short positioning. But in absolute contracts, well, it's much lighter. FIs are net short, but not as aggressive as what we saw at the start of the previous series. That's at the start of the April series, though in percentage terms is a little bit higher. You have shorts in the system, though. While the clients, well, they are net long. And the net long positioning is holding at around that 73% odd mark. But in terms of absolute contracts, the client long positions as well, relatively low. On stock futures, well, the FI longs on stock futures are a little lower than what we saw at the start of the last series. The client longs as well, a little bit lower than what we saw at the start of the last series, though both of them continue to remain net long on stock futures. The FI is selling. Well, that continues. But the question is the peak selling behind or is it ahead? But if you're just going by the data points, well, it appears that at least the FI selling has cooled off. And on some days, you're getting some buy numbers as well. That's heartening to see because you don't want them to get back to that $1 billion of selling on a per day basis. Moving to the levels, then you have 2 reference points. On the downside, the 20-day MA, that'll be the first reference point. So that'll be the crucial support that you're looking at. While the recent high, which was at around this 24,600 odd, that becomes a bit of a resistance mark. So we're in this 900 to around 1,000 point range on the Nifty. And a break decisively on either of these levels will give you direction from here on. So that's the range for this series itself. In terms of cues for May, we've got plenty of cues, right? State election outcomes, we'll have earnings season as well. That will play out. You have central bank meetings, both the RBI as well as the Fed will keep an eye out on commentary, particularly from the Fed later this evening. And cues with regard to the monsoon as well will be tracked. So a lot of cues. And just one more data point. Over the last many years, May actually has been more positive than a negative month. The average returns have been closer around 1.5% or thereabouts, and 60% of the times the Nifty has ended the green. So the bulls will want to see some green even in May after a rocking April series.
Thank you very much for that. Let's invite on the show Jahangir Aziz, co-head macroeconomic research at JP Morgan. Jahangir, great to have you. Thank you very much for joining in. Let me begin with UAE's decision to exit OPEC and OPEC+. What, to your mind, are the implications? Of course, in the near term, not much changes because of the near closure of the Strait of Hormuz. So anyway, exports are being capped. But do you think this exit by UAE signals perhaps the beginning of the end for OPEC as we know it? What happens to crude from here on?
Look, you're asking me questions I have no answers to. Look, you've seen the public statement. Why the timing? Why now? I think, is best left in the public statement that UAE gave, and I really do not have any further insights into that.
What's your sense, then, moving on to the other topic, what's your sense? The stalemate with respect to the US-Iran war continues. The blockade is stifling exports. It's hurting Iran. How do you see this playing on? It's gone on way longer than anyone's baseline imagination. 2 months now, third month starting.
Right. Right. So, I mean, that's clearly is the issue. The issue is that, look, we have a indefinite ceasefire, and the assumption was that there would be negotiations taking place. Negotiations are probably taking place, but indirectly through third parties rather than directly, and that obviously creates uncertainty as to when and how this conflict is going to get resolved. Clearly, the positions on both sides are, quite far apart on various issues. So I think the market is gradually getting to sort of price in that perhaps this conflict is going to last longer than they had expected. I will admit that, as you pointed out, the conflict has already lasted longer than one had expected back in 20th of February. But I think right now, I think the market is, if you look at both the futures prices as well as the dated Brent price, which is the physical price, both of them are sort of creeping towards pricing in a much longer shortage or much longer stoppage in supplies, and that obviously is not very good either for oil prices or for the supply shortages.
I've got that. Jahangir, yeah, but it's hitting Asian economies a lot more, right? So far, the government's taking the hit, but I guess with elections wrapping up today, expectation is that we will see some increases being passed through consumers as well. And I guess at some level that is necessary as well, right? I mean, consumers, that adjustment needs to take place.
That's correct. And look, let's go back to previous episodes when we did have these kinds of oil price shocks. At the end of the day, if you look at, the overall stance of the government, it has always been that, look, everyone has to share the burden. It cannot exclusively be either on the budget or on individuals or on corporates. And that's more or less what's happening. Again, you can quibble with the timing of it. But yes, at the end of the day, we will see this adjustment being borne by corporates, the budget as well as the exchange rate. And that's essentially how in the past, regardless of whether it's this government or previous governments, have all adjusted to or reacted to oil price shocks exactly in this manner.
Just one more, and this is kind of sort of gone to the back of the mind in that sense, right? That we've got the investigations against Fed Chair Powell now being dropped. I guess the road becomes clearer for Kevin Warsh. I mean, just to jog my own memory more than anything else, this is dollar negative, right? I mean, the policies, etc., which he's espoused and he kind of sort of spoken about.
Look, it's very hard for anyone to, look at the price shock coming from the oil price shock and then looking at the unemployment numbers. The unemployment rate is actually 4.3 to say that there can be scope or space for, at least in the near term, rate cuts. We don't have a rate cut at all for 2026. In fact, the first next move by the Fed to us is a rate hike, but in 2027. And broadly, that seems to be playing out. So unless you get a really big negative shock on the economy, which doesn't seem likely at this point, it is very hard to see how you can get, the kind of things that the new chair is talking about. So again, you can never say no, but I would say that it's very hard to envisage under these current circumstances, rate cuts in the near term.
Yeah, but outside actions around interest rates, Jahangir, I mean, just like if you can quickly wrap up what the consensus expectation is with in terms of what his policies, what he's espoused, and what. Yeah.
Look, clearly Yeah, clearly the consensus is that he has made this argument. There's clearly pressures on the Fed to cut rates, and therefore some amount of cuts being priced in. But again, if you look at the rate cut that's being priced in, that keeps changing. And right now, it isn't that the mean of the distribution is looking for a rate cut. There are parts of distribution that are looking for rate cuts. But again, it is very hard to see how. Look, at the end of the day, the chair is just one vote. The chair has to be able to get the entire FOMC behind him in order to get, or at least a large part of the FOMC behind him to get a rate cut. And it's very hard just by looking at the fundamentals to say that, you're going to see rate cuts. I mean, look at Bank of England, look at ECB, Bank of England, you can argue that, the fundamentals are such that they need to be hiking rates. You can make the same argument with Bank of Japan. ECB, you can't. ECB rate hikes that are being priced in are essentially that people are afraid, or ECB is afraid that this spike in oil prices can actually start unanchoring inflation. So if the major central banks around you are not cutting rates, they're in fact hiking rates, my sense is that, at best you can hope for is a hold coming from the FOMC for the best part of the year.
Well put, Jahangir. Thank you very much for joining in. But the street is still a divided house. Just yesterday, we had Rob of Nomura calling for 2 rate cuts in 2026. And JP Morgan here has a hold. And the first rate change will be a hike, but that's in 2027. Thank you very much, as always, for joining in. Our pleasure.
Sure.
All right, let's move on and tell our viewers the interactions that we've lined up on the show today. So first up, 8:35, the management of Maruti Suzuki will talk about the Q4 numbers, the way forward. 9 a.m., the management of Canara, HSBC Life. 9:20, Raman Johar of Axis Capital will be a market master for the day. 9:30, the management of AWL Agri joins in on their earnings. Following that, MV Photovoltaic will be chatting with us. 9:40, 9:50, Castrol India. 10 a.m., Madison Sumi Wiring joins in. And towards the end of the show, Lata speaks to experts about the challenges posed by MyThought's AI model to India's financial sector and public digital infrastructure. Interesting discussion. Stay tuned for that.
Time to slip in a quick break. We've got a lot of stock-specific action track for you. Get to that in just a bit in our special Top 10 segment. But we're looking at Dr. Reddy's, Garden Reach Shipbuilders, AVL Agri Business, Star Health, CEAT, as well as 5-Star Business. All of them will be reacting to positive news flow. While we have Go Digit General Insurance, Piramal Pharma, REC, and Bandhan Bank that will be reacting to negative news flow. Stay tuned. We get into further detail on all of these names.
Welcome back. It's going to be a busy day of earnings, so let's straight away get to it. This is CNBC-TV18's list of top stocks for the day. Dr. Reddy's is the first stock on our radar. Ekta joins in with more.
Well, yes, Dr. Reddy's is in focus because, they've received that final approval from Health Canada for semaglutide, which is basically the generic version of Ozempic and Wegovy, the weight loss drugs by Novo Nordisk. Canada is the first G7 country to give a nod to semaglutide generic. Remember, the market size in Canada is expected to be one of the largest after the US, over $1.5 billion. Dr. Reddy's had already received the drug identification number from Health Canada on 22nd April. So the street was factoring in a possible approval coming through. Now, it is in line with the timeline which the company had provided by end of May 2026. Health Canada, in fact, is reviewing 8 other submissions for semaglutide, and they have said that they will make decisions in the coming weeks or months. So that would be a key factor to watch out for, because currently analysts are expecting 6 to 9 months of no competition for Dr. Reddy's in the Canadian market and working with around $80 to $100 million of revenue in FY27. 2 more players are expected in the next 1 year, according to analysts, Sandoz and Apotex, and eventually 7 to 8 players to enter the market. But the dynamics could change if in case Health Canada does approve any kind of competition to Dr. Reddy's in the coming weeks.
All right. Let's just stick with pharma, and Piramal Pharma is next on the radar. Ekta, back to you.
Well, yes, Piramal Pharma, I'm going with red because on a year-on-year basis, the numbers don't look great. So on a year-on-year basis, revenues are flat. The OPEX has risen around 14% EBITDA is down 38% Margins have come in at around 17% versus 27%. And there's a loss of around 8.8 crores. But Q-on-Q, the company has shown a recovery. The revenue is up around 28% Q-on-Q, and margins have recovered from that 9.1% level in the previous quarter, and the losses have come down. But because it's more there's more of a comparison on a year-on-year basis because of the business dynamics, I'm going with red for Piramal Pharma.
Thank you. Let's talk about AWL Agri-Business. Mangalam, how did the numbers look?
Well, for AWL Agri-Business, they're on the right side of the commodity cycle, so this benefits the up move that we've seen in crude, and as a result of which, the related oils as well. So you have edible oil, palm oil, and all the other important soya oil up anywhere between 7 to 10% quarter on quarter. The company's seen the benefit of lower inventory, and as a result of which, if you look at their overall revenue as well, that's seen an 18% jump. The EBITDA has actually jumped by about 17% as well. The net profit is a 54% jump. The other income of the company has further boosted the net profit. The important part is the edible oil business, which accounts for nearly 90% of their revenue. Out there, the revenue growth has been 18.5%. The margins have improved from 1.2%, it's a low margin business, to 2%, which implies an EBIT jump of 94%. What actually took away from the overall reported numbers was the weakness that we saw in the industrial essentials business and the food and FMCG business. But the core of the business remains strong, and hence I'm going with green.
Okay, all right. Thanks a lot for that, Mangalam. Going with green on that one. Well, let's hop across to Yash. He's here to tell us about Star Health as well as Go Digit. Morning, Yash.
Morning, Nigel. So let's start with Star Health. I'm going with green on Star Health. The numbers for the fourth quarter have turned out to be very, very strong, both on a year-on-year basis. Also, against what CNBC-TV18 poll was expecting out of the numbers, the net earned premium, that has seen a growth of about 14%. The operational numbers are very strong, largely because commissions and total expenses have come down very sharply. Underwriting loss, that is reduced by about 44%. Operating profit has come in at about 64 crore against a loss of 87 crore. Importantly, combined ratio, strong improvement seen there, 94.73% versus 99.14%. The street was expecting a number of 97.9%. So, of course, improvement on all sides. On Go Digit, I'm going with red. The numbers have been weak. Net earned premium growing at just about 2.5%. Underwriting loss, that has seen a sharp increase, going up to a loss of about 200 crore as compared to a loss of 179 crore. Operating profit, that has come in at about 611 crore versus a profit of 429 crore. But the operating profit has increased because of the jump in investment income largely. Importantly, combined ratio, because the operational performance is not good, that has come in at about 111.6 versus 111.3. So, of course, not much improvement there, and hence I'm going with red on Go Digit.
Thank you very much for that. CEAT looks like it's reported a strong margin expansion. Sudarshan, what are the numbers?
So even in the current situation, CEAT has come out with its earnings for Q4 FY26, and by the first look, the earnings are looking very strong. Company has reported double-digit revenue growth. It's up almost 23%. EBITDA has seen a jump of as high as 52%, and margin is back of 14% after a few quarters. And it's coming at 14.2% versus 11.5%. Even on the gross margin, there's a dip on a sequential basis, but YOY, there is a sharp increase. It has come at 39.7% versus 37.5%. On the volume front, two companies saying that it has seen a healthy volume growth, and it's across the segments. As far as the demand is concerned, it was led by OEM and international segments on a sequential basis, and replacement demand was flat, and realization too was flat on a sequential basis, and YOY it was up marginally. So I'm going with green because of two things. First, double-digit revenue growth, and there's a sharp increase in the margin.
Thanks a lot for that, sir. Well, let's go back to Ria. Ria, tell us about Garden Reach Shipbuilders.
Well, yes, very strong performance from Garden Reach Shipbuilders in this quarter. Revenue growth has come in at 29% on a year-on-year basis, largely led by a pickup in execution this time around. Margins have also expanded by over 300 basis points on a year-on-year basis and almost 770 basis points sequentially as well. Even EBITDA and net profit seeing an uptick of around 61% and 24% respectively. The profitability this time around has been supported by lower material costs at around 49% of the revenue versus about 67% in Q4 of FY25. However, it is important to note that the subcontracting expenses have gone up by 3.5 times compared to the previous year, and even other project-related expenses have gone up by around 2 times, so sharp increases on both of these fronts. But even if you look at the full year performance, the FY26 revenue has crossed 7,000 crores for the company, up around 38% on a year-on-year basis, well above the company's guided range of 25 to 30% growth for the year. And this is also higher than the provisional business update that the company had come out with a revenue of 6,400 crores. Strong improvement in profitability on a full year basis as well. The order book details have not been disclosed yet. It stood at around 18,400 crores as of the end of Q3, and the company had targeted a 50,000 crore order book by the end of the year, hinging on the final approval for the next gen Corvette order. So we are going ahead in the earnings call. We will be watching out for an update on both of these fronts.
Thank you very much for that. So Garden Reach FY26 revenue of 7,000 beats its own guidance of 25 to 30% and higher than the provisional update of 6,400 crores. So that's a guidance beat. Moving on now to REC. Ananya joins in to tell us how the numbers looked.
Now, REC delivered a mixed quarter yesterday. We can see profitability was under pressure due to higher provisioning, and also loan growth was muted. Now, when we talk about operating profit, it declined 19% YOY, while net profit fell 21% YOY and 17% quarter on quarter. Now, margins also softened to 3.5% versus 4.4% last year. Now, the key positive here we can say is the asset quality. Now, gross NPA improved to 0.24% from 1.35% YOY, while net NPA improved to 0.12%. Gross stage 3 asset reduced by 37.4 billion, supported by 14 billion of technical write-off of 5 loans and 23 billion resolution of the Sanar thermal account. Now, we can see stage 3 PCR declined to 51%, which will be a watch point for the company going forward. Now, credit costs also rose to 0.39% due to 2.7 billion additional provisioning towards letters of comfort and undertakings. Now, loan growth remained weak during the quarter at just 3% YOY and 0.3% quarter on quarter. So overall, we can see REC saw a strong balance sheet cleanup, but there were pressures on margins and earnings.
Okay, well, more financials, right? Bandhan and Five-Star Business Finance. Ananya, back to you.
The Bandhan Bank and Five-Star Business Finance both delivered their Q4 results yesterday. And let me first start with Bandhan Bank. It was a strong recovery quarter for them, we can say. Now, NII grew 1.4% YOY and 4% quarter on quarter, while PAT grew 68% YOY and 160% quarter on quarter, mainly driven by sharply lower provisions. Now, margins improved with NIM at 6.2% up 30 bips quarter on quarter. Advances grew 13% YOY and 6.2% quarter on quarter, while deposits grew 10% YOY and 6% quarter on quarter. CASA improved to 29.3%. Now, asset quality was the key highlight. GNPA remained stable at 3.3%, NNPA improved to around 1% and PCR at around 71%, and slippage ratio improved to 0.7% from 1.09% quarter on quarter. Credit cost also reduced to 2%. Now, management commentary was positive. They said the microfinance stress is now largely normalized, collections have improved, and slippage should reduce gradually. They maintain 14 to 15% loan growth guidance, expect 10 to 20 bips NIM improvement, and 1.6 to 1.7% credit costs, and 1.6 to 1.7% ROA by FY27. And now, on ECL, management estimated the transaction impact at around 12.5 billion to be amortized over 5 years, with annual capital impact of only 16 to 17 bips, making it manageable. So overall, we can say it was a turnaround quarter for Bandhan Bank. Now, coming to Five-Star Business Finance, they delivered an improving Q4 with early signs of recovery. Now, AUM grew 11% YOY and 2% quarter on quarter, while disbursements rose 24% quarter on quarter, indicating growth momentum is returning. Now, PAT declined 4% YOY. Net interest margin remained very strong at 20.07%, while ROE was 15.09%. Now, collections were the biggest positive, with efficiency at 98.1% and slippages improving to 0.7% from 1.09% last quarter. Now, gross stage 3 stood at 3.37% and net stage 3 at 2%. 5%, now showing stress is stabilizing. Now, the management commentary was optimistic. They said now the stress is now behind them, and they guided for around 20% AUM growth in FY27 with a full collection vertical now operational from the first quarter of FY27. So overall, we can say it was a confidence-building quarter for five-star business finance.
Thank you very much for that. Well, those were the stocks. Let's now talk about commodities, where crude prices continue to remain very elevated. Manisha is now joining in with a complete roundup.
Thank you so much for that. Well, I'll start with the crude oil prices, which have gained 3% overnight, continue to hold around $111 a barrel right now. It also has to do with the fact that the U.S. and Iran peace talks are largely stalling. U.S. could sanction China and other countries paying fees to Iran to secure transit. But the major blow really comes in the fact that UAE will exit OPEC and OPEC Plus from 1st of May. Remember, OPEC was established in 1960 and UAE has been a member since 1967. So this definitely comes as a blow. UAE also is the fourth largest OPEC oil producer, and the markets would be looking at impact of that going forward. So while the energy prices are trading on a higher side, almost everything else is trading slightly weak. So gold fell 2% overnight, silver fell 3%, platinum is trading at a 1-month lows, copper around at 1-month lows as well. The strength in US dollar index clearly weighing on many of these metals.
All right, Manisha, thank you very much for that. We'll take a quick commercial break here. Maruti reported yesterday, and the numbers, of course, came through while markets were trading. The management joins us on the outlook going forward. So Mr. R.C. Bhargav, as always, to Maruti on the other side.
Welcome back. You're tuned into Bazaar Morning Call, and it's that part of the show when Hormuz joins us to tell us about all the big movers yesterday and some of them that were backed by good delivery. Hey, Hormuz, morning.
Morning, Nigel. And the last couple of days, the one stock that has stood out is Reliance Industries, and the one that kept the Nifty downside in check in yesterday's trading session. The stock is up almost 4.5% over the last 2 days now, and volumes also rising for the last 3 sessions. The premiums on the 1400 call option for the May series was up over 30% yesterday. The 4 crore shares were traded yesterday, double of its 20-day average, and 65% of the total shares traded were marked for delivery. And that has been the trend in 4 out of the last 5 trading sessions where delivery volumes have been in excess of 60% of the total shares traded. So close to 3 crore shares for delivery yesterday, the 20-day average of 1 crore. But the stock is now approaching a very key level of 1400 rupees. It has not closed above that level since the 25th of March. And of course, it was the most traded stock on the Nifty 500 yesterday. The other one that did very well yesterday was Tata Chemicals, and it was the biggest single-day gain for the stocks in over 2 years. And the stock is up 16% now in the last 2 sessions. The volumes on Tuesday were the highest in over 2 years as well. 2.5 crore shares were traded. The 20-day average is only 20 lakh shares, and 12% of those shares were marked for delivery. So the 30 lakh shares for delivery, the 20-day average is over 4 lakh shares, and the stock up over 38% in the month of April so far, but still significantly below its 52-week high, which is in excess of 1,000 rupees. And lastly, of course, the oil price rise beneficiaries, ONGC and Oil India, both of them doing very well yesterday, seeing gains of anywhere between 4.5% to 5.5%. The call options, the 300 call for ONGC and the 500 call for Oil India, both of them were very active yesterday. Premiums rising anywhere between 90% to as high as 160%. The 5 crore shares traded on ONGC significantly higher than its 20-day average, and Oil India too had more than 1 crore shares being traded. For ONGC, close to 3 crore shares for delivery, and for Oil India too, significantly above that 20-day average.
Thank you very much for that. Moving on now to Maruti Suzuki. It's the first management on our show. The company reported an inline set of numbers. Revenues grew double-digit, but profits declined on account of a sharp drop in the other income and higher taxes. We have with us Mr. R.C. Bhargav, Chairman of Maruti Suzuki. Thank you very much, sir, for joining in. So there's been a sharp increase in commodity costs over the past few months, and it has led to some drop in your margins. So what is the plan with respect to a price hike? Some of the other OEMs have already announced a price hike. And 2, what is your own sense of commodity trends going forward?
It is very difficult to predict because a lot of the price increases happened partly because of the foreign exchange fluctuations which have been happening, partly because of the war situation. How this plays out, we are not very sure yet. And therefore, we have to watch and see what is going to happen. And you're right, absolutely, that in the last year, we have lost more than 2% of our sale value because of higher commodity costs. So, yes, we will take a decision on prices as soon as we have a little more long-term certainty about what is likely to happen.
All right, sir. Good to speak to you as always, sir. But just to take that point forward, any timeline you can tell us on the price revision? If one can expect the price increase, say, in a month or over the next 1 to 2 months?
I'm sorry, I won't be able to give you a timeline like that.
All right, we'll wait by then for that. But let's come to the question on demand then. It sustained the uptick we started, that we saw in the second half of FY26. What are the domestic volume growth estimates for FY27? And on exports, what's the contribution? Will it continue to rise? Are you seeing healthy growth? In quarter 4, it rose from 20% to 20% from a level of around 15%. So what are the expectations on exports? Please go ahead, sir.
See, the expectation of growth for the industry as a whole, I think SIAM has put out a figure between 5 and 7%. Our expectation is that compared to last year, we should grow at 10% plus. And we expect exports, which this year were in excess of what we had planned at 447,000, that exports will more or less remain at that same level. Our ability to grow faster is limited by production capacity. As I said, we have added 2 new lines recently. They will gradually pick up volume of output. And we expect that these 2 lines will give us around 250,000 cars this year, which will roughly give us a 10% growth rate. We can't grow faster than that even if we wanted to, because there is no production capacity. We are running at more or less 100%.
So, sir, what you're saying is that your domestic growth will be 10% in FY27, but you can't grow faster on account of production constraints. You are at 100% utilization. How much more time before you will be able to eliminate these production constraints and you get to normal levels?
No, it's not going to be in the past at all, because, as I said, we are adding 500,000 capacity now. That 500,000 will give us, in this financial year, roughly 250,000 cars. 250,000 cars will give us 10% market growth. If the market grows faster than that, we will fall behind industry. If the market grows less than 10%, if the SIAM prediction is right, then we will gain in market share. But it all depends on how the total industry grows.
All right, so let's focus on a couple of your segments then. On the entry-level segment first, post the GST cut as well as the rate cut, there were certain decisions you had taken, and that's why we saw growth on the entry-level segment. But again, in the last 2 months, the segment has seen a bit of a decline. Any strategy going ahead from here on? And also I want to ask you on SUV. It was another quarter of almost 40% volume growth. Are you confident of maintaining that sort of a trend?
The SUV demand seems to be strong in the industry as a whole, Maruti also. I don't see any drop in that because, these SUVs and this mid-sector SUVs, these are bought by people who are reasonably affluent, and this class is growing. The small car segment, of course, is much the larger segment, and affordability there has always been an issue. The sales fell because there was lack of affordability. The GST cut restored to a large extent affordability. The market has come back. I don't know if there's a real downtick in the sales demand. Obviously, the initial euphoria has not remained as strong, but I still think that there's a lot of potential in that segment. In addition, we have also to think longer term as to what would be the appropriate way of providing safe, convenient transport for the 280 million people who are registered owners of two-wheelers. What is that market going to become? And from where will it go?
So, sir, taking your point forward on the long-term view for providing safe and convenient transport to 280 million registered two-wheeler owners. Now, the government recently released the CAFE emission norm draft and is looking to push for the transition to EV. What is going to be the strategy on that? Would it be difficult to meet the timeline? What's given in the draft? Is Maruti well placed to meet the norms?
No, let us wait for the draft policy to ultimately issue as the final policy. And but one thing I'm sure of, Maruti has always met all regulatory requirements without difficulty. I don't see that changing in the future.
All right, so any EV launches we can expect over the next few months?
We don't announce in advance, but what you can expect is that at the next auto show in 27, there will be an EV on display.
Okay, one final question then as we wrap, sir. Would it be correct to say that Maruti will outperform the industry in FY27 and that FY27 will be better than FY26?
Assuming the domestic market growth is 5 to 7% as predicted by SIAM, we should be outperforming the industry.
And we wish you all the best, sir. And on that optimistic note, we'll thank you for joining in and speaking to us here at CNBC-TV18. Wishing you all the best for the coming fiscal. Well, time to slip in a short break. Up next, we have Dharmesh Kant of Chola Securities who will be joining in to help us out with some fundamental stock talk.
Welcome back. Dharmesh Kant is head of research at Chola Securities. He's with us. Dharmesh, good to have you with us here. Thanks very much for joining in. Dharmesh, the big movers yesterday, right? And I think we did discuss it. I don't think you particularly like it. Are the oil upstream names, ONGC and Oil India, etc. Every day that oil stays higher, people, I think, are maybe forced to look at it again, but there are risks here as well, especially now with elections ending and perhaps some redistribution of the burden of higher prices coming through. So we'll see how that really goes on. Indigo, I just wanted to ask you to respond to. Our colleague Madiha yesterday reported that airline companies are asking the government to actually step in and help because they're saying that ATF prices are through the roof, unprecedented levels. Much higher than what actual underlying oil prices have done. So they're asking the government to step in and put in a mechanism to control the spreads, which means, some kind of capping on the refinery side. Just your views, Dharmesh, Indigo?
Yeah, good morning, Prashant. Thanks for having me for the show. The problem with this higher fuel cracks and ATF prices has been because of the Strait of Hormuz issue. To our mind, I don't think it's likely to continue like this for several months going forward. Maybe 1 or 2 months it can still be there, but this impasse has to end sooner than later. That is what our understanding is. And keeping that point of view in light, so this quarter is definitely lost Q1 for Indigo, and there would be operating losses coming through for Q1 FY27. But decline should be bought into because they remain a dominant player in the domestic circuit, as well as they are the only ones who are having a good share into the international market as well from the Indian airlines industry. And if some comfort, some government help comes to them through some sort of easing out of the burden of the fuel prices presently, it's a welcome and a move for them. So net, our take is, I mean, this fuel price is staying at $1,213 per barrel on the futures is unlikely to stay longer. So we are penciling in, a sharp correction in crude prices within a month or so.
Okay, all right. Hi, Dharmesh. Good morning. Good to see you again. Dharmesh, I wanted to ask you about the stock of the last 30 minutes yesterday, Eternal. What a spike we saw on the stock. It could have an element of, expiry as well that played out there. But any view on this name?
Yeah, very good morning to you, Nigel. I mean, see, the management con call and guidance side through the shareholder letter has been, very tall claims out there. They are guiding around, say, $20 billion of NOV in next 2 years and $1 billion of EBITDA. That is adjusted EBITDA by FY29. So if you pencil that, basically they are talking about $30 billion of NOV by FY29. So $110 billion of adjusted EBITDA to $1 billion of adjusted EBITDA in next 3 years is 9-fold jump. So if you are buying that out, what management says, and they actually deliver that, then the stock is available very cheap. I mean, it's 26 to 27 times EV to adjusted EBITDA margin, and that adjusted EBITDA will actually translate into PAT. And with a 9-fold jump, it's very much cheap out there. But to our mind, I mean, there's a big dichotomy out there, because management also hinted at 15 to 20 tier 1, tier 2 cities has already been explored. And now it is the turn of tier 3 and 4 cities where they will be expanding their business. And those are not convenience or comfort centric kind of a business place. There, the business dynamics is more to value and what kind of a better deal they are getting out there. So I think there will be more of a cash burn. If you look into the verticals, so 60% plus growth for the quick commerce business they have guided. But to achieve 60% plus kind of a CAGR, you need to look at a sequential basis. So quick commerce business was doing well in Q1 and Q2 on a sequential basis. 25-26% kind of a growth was there. But Q3 it was 13.8% and Q4 it's fallen down to 8.6%. So I mean 10-11% kind of a growth on a sequential basis cannot take you to a 60% plus kind of a CAGR. You need to have 12 to 13% kind of a CAGR. And putting that in mind with tier 3 and 4 cities, it looks a bit challenging. Secondly, I mean, they are talking about margins expansion upon 3% quick commerce business adjusted EBITDA margin going to say 5 to 6%, but that timeline has not been defined. But even if you take this $1 billion of adjusted EBITDA margin, that translates to 2.2 to 2.3% kind of adjusted EBITDA margin by FY29, which again, having light to the sense that tier 3 and 4 cities would be coming into play. I don't know how both will fall into place. So, I mean, market will definitely give it a benefit of doubt as of now. Couple of 3-4 quarters they will be watching. 220-40 will be a floor price as 0.3, that is 0.5 or 1%. Kind of adjusted EBITDA margin, you will see a stock price traction. So maybe 300, 320 is still gettable in the medium to near term. But long-term perspective, as this realization dawns that 5-6% kind of EBITDA margin or NOV growth is not possible, will restrict the upside. So it's a range-bound stock to our mind. Food delivery business will continue to do 18-19%, maybe 20% is doable. So net, the business will survive, but in light of a competition which is shaping in, we don't see, I mean, the guidance, coming to by FY29, both the front. I mean, NOV guidance of $20 billion, and the EBITDA of $1 billion by FY29.
Okay, all right. Dharmesh, the other big story, of course, is IT services and what will be the shape and form of things to come for IT services. Huge de-rating has already happened. How much more to go? Are we at the point of maximum pain? I mean, that basically was the underlying question. We did a CNBC-TV18 market town hall, market forum, and, that's essentially what we tried. We had an excellent panel of speakers. So I just want to play out some of the opinion that we essentially got. And we'll do this through the course of the day and over the next many days. Frank D'Souza is, co-founded Cognizant. He ran the company as CEO for many years. He's now the CEO at Recognize, which is an investment fund. And we also had Srikanth of Fractal Analytics, who's basically in it Nilesh Shah of Envision Capital, who's a veteran investor, tracked IT services space for a long, long time. So just some snippets to get you a flavor of the kind of opinion that we got yesterday at that forum.
Code has never been more valuable. If you look at the valuations that underpin firms like Anthropic and OpenAI, and even Main Street firms like Walmart, these valuations are based on the value of the code that these companies have. But yet, the value of coding, the act of producing that code, is going towards zero. So you have this great decoupling going on where the value of code has never been higher, and the value of coding is heading towards zero. The second paradox is that creates a paradox of complexity, which is that abundant code, which is what we're seeing now, does not necessarily translate to reliable software. Those two things are very different.
I'm narrow at the top, I'm narrow at the bottom, but I'm fat at the middle. That is something that doesn't ring well for me, because that's exactly what the companies are doing right now. So what companies are doing are they're not hiring entry-level talent because they can replace that with some AI tools. But this is not a sustainable org structure. For the last 200 years of the world, no company has survived a diamond-shaped org structure, so I don't think it will work even today. Increase the density of talent. You still have a pyramid. In fact, make it even flatter and have extremely high-quality talent that is inexperienced but is extremely high quality. That is the kind of pyramid I would build, a flatter pyramid rather than a diamond.
The challenge always is that investors always look for relative growth. It's not so much about legacy and entitlement. Just because you're a fantastic company, a great balance sheet, after a point of time, that doesn't mean to value accretion. Value accretion will come from capital efficient growth. And today there are many other sectors which are growing in double digits and have the potential to sustain that. So till investors do not see a double-digit growth, I do not see a case where these become very strong long-term investment candidates. Yes, you can have a bounce back and all of that can happen, that you come down to a 12p multiple and you bounce back to a nifty p of 15 times, something like that. Then that's quite possible. Or if a company gives a guidance of 1% to 4% and a company delivers 3%, and obviously the markets will cheer it temporarily, saying, wow, this is at the top end of the guidance. This is fantastic. Okay. But I think
those are just bounces.
After a few quarters, a year, 2 years, 3 years ago, and you look back and say, hey, the growth was just 3% or 4% or 5%. Do you want to be in equities for that? Are you in equities to make 3, 4, 5%? Then you're better off being in bank fixed deposits.
Well, it was not all negative, and that last soundbite from Nilesh, of course. But there was a lot more to it. As I said, we will play out soundbites from all of the guests we had, and as I said, some excellent speakers through the course of the day. We'll take a quick commercial break here. We'll come back with the pre-opening rates. We also have the management of Canada HSBC live to talk about the fourth quarter performance. We'll also connect with Mitesh Thakkar and Sudarshan Sukhani for some technical trading ideas coming up.
Welcome back. We still have Dharmesh Kant with us. Dharmesh, many mid-caps came out with numbers yesterday. There was MV, 5-Star, Garden Reach, Go Digit. Any amongst these or the ones that you track was a standout result of yesterday?
Garden Reach Shipbuilders definitely came out with a very strong set of numbers. And we are, bullish on the shipbuilding space. But though not on Garden Reach Shipbuilders, so we have, of late recommended Majgaon Dock as a buying idea in our mid-cap high conviction theme portfolio. And the reason for that is, one is their order book is strong and most of the executions are likely to take place in FY27. The second is P75I submarine deal, if it goes through, almost it's on the verge of, signing off in next 2 to 3 months. That itself is around 1 lakh crore size of order book. So that would be 5x of what they are sitting on. currently, and it would be executable over a period of years. But that also is margin accretive. It's a 50-50% kind of a JV between them and the ThyssenKrupp of Germany. So it will bring them into a different, orbit altogether. They have already come up a long way from being ship overall or reparation builder kind of a player to a frigates, fighter ships builder out there. Margins have climbed from 4-5% to 12-13%. So there we are having a high conviction bet out there. Though the price targets we have not given, but we think as this deal emerges, then it would be a better place to give a price target to it. But 15-20% kind of an upside is doable on that.
Yeah. Got that. We'll leave it there. Thank you very much, Dharmesh, for joining in. There's some news at the bottom of the screen. Shyam Metallics has announced, I think, some expansion. I saw that flash coming through. Well, let's just get you quick technical trading ideas as well. Mitesh and Sudarshan are with us with what they'd want you to do. Gentlemen, good morning. Good to have both of you here. Sudarshan, you go first. What's the trade?
Good morning. Well, the trade is the same as yesterday. Do not trade. Yesterday, we saw how choppy the market became up and then down. The same scenario is likely to play out today. The Nifty is not in a momentum-driven phase. So we are not looking to buy breakouts. The only way we can trade is to wait for a 200-point dip towards 23,800. That's an unlikely scenario. But if you come to that level, then buy with a 150-point stop. If that doesn't happen, I would suggest stay away from the Nifty.
All right, Mitesh, what would the Nifty call be for you?
I've been advocating that, we might actually go into some kind of a narrow and choppy range. I think that view continues. For me, this is a market which looks like might not do much, and the next few days could be more spent sideways. Therefore, since yesterday, I've been advocating that trading should be more focused on stock-specific pieces.
And Mitesh, what are those stocks?
Yeah. So, good morning, Prashant. On the stock side, I have 3 buys and a sell. A buy on Glenmark, which made a fresh high. Keep a stop at about 23.69. Look for targets of 24.80. Jubilant Foods is also on the buying side. Keep a stop at 4.71 here. Look for targets of around 5.05. And GMR Infra is the next call, where I would recommend buying with a stop below 95.9 for a target of 102. And one sell call, that's SBI Cards. Keep a stop at 660 half, look for targets of 622.
Sudarshan, what about you?
Tata Power is a buy with a stop under 450. Bharti Airtel, after that sharp correction, is a buying opportunity with a stop under 1815. Lupin is a short. It's a short sell with a stop above 23.46. And PNB is a short sell with a stop above 115.
By the way, Rima, the rupee, look at the rupee, right? 94.74. And how fast we've come back above. It got pushed, right? I mean, with all the circulars and the measures that said the Reserve Bank of India pushed it beyond 94, 93, the 93 handle. And now we are back closer to 95 than we are to 94. And that's the problem. Every day that oil prices stay high, $110, $111, if you're sitting out there in the US, or you're trading US stocks, and you can say, well, it doesn't matter because you've got, the left tail, right tail. Left tail, you've got all this energy and the cost of energy, which is going up. But on the other side, you've got, there's this boom in AI, which is kind of counterbalancing and more compensating for all of the other stuff. And of course, I mean, the fact is that there is no big macro implication for the US of high oil prices because, as I've said repeatedly, they are a net energy sort of exporter, surplus country, not so much, a large importer. So they can hold out. I mean, you can say, well, this is continuous and we want this and they want this, but the damage is not. The damage, of course, is if oil prices go up from here. But 110 is high enough. $110, $111 is high enough, and that is problematic in that sense. So we'll see how this goes, and maybe what else the Reserve Bank of India. What's the thinking in that sense, right? Out there in the market, and whether they'll push back and at what levels, etc. But this is a problem. For a lot of things, flows, if the rupee keeps depreciating, You don't want, and the expectation is embedded that it'll depreciate more, then you wait. You don't put money to work. The same thing with exporters. Why would you convert and supply dollars if you think that you'll get a better rate? So, on both sides, it's problematic. But a 0.25% higher on the dollar rupee right now, which means that much pressure on the rupee here this morning. Rima.
Okay, let's invite the management of Canara HSBC Life in focus on the back of the Q4 numbers. There was a sharp rise in the value of the new business. VNB margins also expanded by 825 basis points. We have with us Anuj Mathur, MD and CEO of the company, now with us. Thank you very much, Anuj, for joining in. This is Rima here. Let's talk about the VNB margins. For Q4, over 30%. What led to the sharp jump in the VNB margins? What was the GST impact? If you exclude that, what would the normalized margins look like? And same thing, what can you guide for FY27 in terms of VNB margins and growth?
Thanks, Rima. Thanks for having me on the show, and good morning to all the viewers. In fact, this is the first time after listing that we are presenting our full year business performance. So very happy with the outcome. We have seen very decent growth, and as you rightly pointed out, our VNB margins have improved. If I look at our absolute VNB, that has also improved. So there are many factors actually which has impacted VNB. And first one is the protection mix, which we have been able to increase significantly. So that's paying off. Number two, our focus on traditional business, particularly in the last quarter, that has helped us in optimization of VNB. Obviously, there was some dent because of the GST and the new labor code. But overall, we were able to neutralize the impact because of the positives which I talked about.
And what's the guidance for the VNB margins for FY27, and what will be the GST impact next year?
See, GST impact is now baked in, so I think it's part of the business now. Last year, it came as a surprise in the middle of the year. So if I talk about the attribution, what we saw last year, that roughly our impact because of GST was about 1.85%. That's what we saw on the VNB margins. Coming to guidance for this year, we expect our VNB margins to be in the range of about 22 to 23%. That's what we feel we can deliver this year.
Got that. Mr. Mathur, good morning, sir. Thank you for joining us. I had two questions, Prashant, this side. One is, the companies, of course, will grow at varying speeds and they'll do things some differently and some the same. But right from the top, in terms of the government, the Reserve Bank of India, there is and we've seen this publicly espoused aim to increase insurance penetration in a big way and do whatever it takes to get it done, right? Are we on the cusp of, regulations which will change the structure in the industry? One of the things, of course, is, who is able to sell these policies, bank assurance tie-ups, etc., right? Should exclusive bank assurance tie-ups be allowed or not? Could you tell us your own situation, sir? Canara Bank or HSBC, do you have exclusive tie-ups with Canara HSBC Life, or they have more tie-ups?
See, first of all, I'd like to mention that the regulatory framework is very positive. The GST exemption, which came in September of last year, has actually helped the business. So there are positive tailwinds, particularly when we talk about the protection business, it's more affordable. So I think overall, the regulatory framework is very good. We have seen good demand for insurance products coming in. And I feel that insurance penetration can increase significantly. As far as the business model is concerned, our business model primarily is bank assurance, and I think that model has worked very well. If you look at our franchise, our distribution network, it's really great. And I think that is what is leading to our growth and will continue to kind of propel our business growth. Now, talking about the open architecture or this thing, in our case, actually, with Canara Bank, we are there. And along with us, there is LIC who's there. So that is the case with Canara Bank. HSBC is exclusive. But in my view, I think the focus should be more on penetration, and it will come through banca as well as agency. By the way, we have launched agency channel also in the month of October, and we have seen good outcome in our initial months. So I think overall, I feel that the business model, which is bank assurance, is good. And for us, there's no challenge in terms of the architecture.
So Canara Bank sells Canara HSBC Life policies, and they sell other policies as well?
They have LIC as the other partner, so they do also sell policies of LIC.
LIC. Yeah. So if they are, if we've heard from the DFS secretary and others, if it's opened up and Does that have an impact? Or are you already sort of, hedging a little bit with agency channel, as you said, to account for that eventuality?
Right. I don't foresee any impact on our business because, first of all, if you look at our penetration, it's less than 2%. So I think there's ample scope. And our business model is very robust. So I don't foresee any kind of challenge. I think we are geared up for whatever is the regulatory ask.
Okay, all right. Hi, Mr. Mathur. Good morning and good to see you in. This is Nigel on this side. My colleague Yash, he put out a story. He said that your foreign partner, HSBC, is looking to hike stake in Canada HSBC Life. Have you heard anything in this regard? Should we expect something soon?
See, I'll not like to comment on market speculation. So I have no comments on this and I have no idea.
But you wouldn't deny it as well?
No, that's a shareholder matter. So I'm not even aware of it. So I think I'd not like to comment on it.
Okay, so we'll wait by then to hear if in case there is any development on that front. But since there was a story that was put out, we just thought we'll have to quiz you on that factor. Let's get back to business. The VNB margins you have given us. Tell us, what about growth? What kind of growth you expect in AP, retail AP?
So last year we had 20% growth in our retail AP, which was in line with the guidance which we gave. This year, actually, if you look at the overall geopolitical environment, there are it's a bit of uncertainty which is there. So we would like to wait for some time to give guidance for overall environment to be clear. So I think at this point in time, we'll not like to give any guidance. But one thing which I would like to mention, that as a company, we have always outperformed the industry growth. If you see last year also, our growth has been 20% vis-a-vis industry growth of about 10%. So that's something which we have consistently delivered over years, that our growth has been significantly higher than the industry. So that's something which I can confidently mention at this point in time.
But sir, in Q4, your APE growth was only 11.7%. Was that also ahead of the industry, or you underperformed in Q4?
No, I think it was mildly ahead of the industry. And we actually did well in terms of our product mix. So we focus more on the traditional mix, traditional policies, where the ticket size is relatively lower. So that's where we got this growth of about 12% in APE.
Mr. Mathur, just last question. I'm going to, again, the channel side, right, distribution side, how it's sold. So out of 100 policies sold, I'm trying to understand, how much is sold through Canada, how much is sold through HSBC?
Right. So Canada is about 72% of our total business. HSBC is under 13 to 14%. And then we have a few other tie-ups, bank tie-ups, which gives us another 6% or so. And our alternate channels currently contributing about 8 to 9%. So that's a broad mix.
Okay. So HSBC is about 14%, right?
That's right, yeah.
But that is exclusive. You're the only policy which they sell.
On the life insurance side, yes.
Yeah. But yeah, so there is that thing. We'll see. As you say, I mean, your share is small, so perhaps you're not the. There is room to grow in terms of distribution, the commissions, etc. Anything changing, sir?
See, in our case, actually, we continue to pay whatever commissions we have been paying, and that way we are very moderate in terms of our commission rates. So we'll continue, and we'll follow whatever regulatory instructions come over a period of time. But we don't foresee any challenge in our case because our commission rates are quite moderate.
Okay. All right. Thanks very much. Good speaking with you, sir. Appreciate your time and good luck. This is, of course, the first of many interactions post-listing that we look forward to. Well, I think we've got Sudarshan and Mitesh back with us with the 9:10 call. Sudarshan, what do you have?
It's Bharti Airtel. Buy Bharti Airtel with a stop under 18.15.
Mitesh, what about you?
You go with a buy on GMR Airports.
Buy on GMR Airports. Okay. Well, thanks very much, both of you. Sudarshan is here and Maruti Concall highlights in focus. So take it away.
So Maruti yesterday released Q4 FY26 earnings, and those earnings were largely in line, but commentary that company has given in the management analyst call and also in our interview is looking largely positive, especially on the volume front. Company is saying that SIAM estimate for domestic PV growth in FY27 is in the range of 5 to 7%. As far as company is concerned, it will outperform the industry, and it is expecting a growth of more than 10% in the domestic segment. On the export front, it believes the demand trend will continue, and FY27 will see the similar trend that companies saw in FY26. And on the price hike, because that's the important factor considering the sharp increase in the commodity cost, companies saying once the clarity emerges related to West Asia war, company will take a call on the price hike. On two factors, that the SUV demand and small car segment, there is no real downtick in small car segment, and believe that demand will continue. And on SUV, company has been seeing a growth of almost 40% for the last few quarters. That there also demand is expected to continue. As far as brokerages are concerned, HSBC maintains buy call target is 15,000. It believes that volume growth guidance of 10% reflects a resilient demand environment and valuation is undemanding. Jefferies maintains hold call target is 13,800 and UBS neutral call with a target price of 13,970.
All right, so thanks very much for that. That's Maruti, about 1.5% higher right now. Quick recap of stocks that we put out since the morning. So Dr. Reddy's Laboratories will be the first one will come up. There is Garden Reach Shipbuilders, which is up 8%. And of course, I mean, it's never one with these stocks. There is, as we open up, we look at Cochin and we look at the others as well and where they are at. There is AWL Agri. We have the management joining us in just a bit from now to talk about the business. Star Health, the South-based insurance company. CEAT, there is 5-star business finance. CEAT is up 8%. It's a very large move coming through. So actually, you've got 2 or 3 pretty decent, forceful moves which are coming through. Go Digit Insurance is there. Piramal Pharma is another one which is up about 0.75%. REC starting 2% lower. Bandhan is up about 4% or so. So that's again, I mean, Bandhan with a 4% bop is a decently large open for a stock like that. We've got market open coming up, and we will look at each of these names. Sugar, perhaps another sector in focus, right? Higher blending, perhaps coming through. 24,100 on the Nifty, so it's a good start. The Nifty Bank is starting about 0.4 higher, 55,650. The mid-cap index and the small-cap indices are also starting in an up and up kind of a way, I think. Mid-cap index is up 0.6 and the small-cap index is up 1%, full 1% right now. Nifty heat map gives you a sense of where we are starting. And then we will pick it up with the individual moves in the broader market. So Eternal is there, Maruti is there, Shriram Finance, ONGC, Coal India, Adani Ports. It's, the bulk of what is starting is higher. Nifty is now 100 points up. So yeah, around 24,100 still. On the other side, Hindalco, Bajaj Finance and SBI Life are stocks which are opening lower. So about 8 stocks are down and the rest of the stocks on the Nifty, at least this morning, are opening in the green. Rima.
Okay, let's talk about some more stocks. Eternal is the top gainer. CLSA says it's a high conviction pick for the company. And even the guidance given by the company is fairly strong, which is why Eternal is the top gainer. Maruti Suzuki is the other big mover, 2.5%. ONGC continues to see buying. In 3 days, ONGC has moved up 7.5% as crude prices continue to hover around $110, $111 per barrel. Tata Motors, passenger vehicles, Eicher Motors, some of the other big movers. Reliance Industries continues to see buying. Now, this large cap is up 5.5% in the last 3 days, reacting to numbers that the street likes and anticipation of the Jio IPO. ITC, BEL, Sun Pharma, Trent, these are a couple of the other names. Coal India also higher in trade. On the way down, you've got softness seen in Hindalco. Asian Paints is correcting, again negatively impacted. ICICI Bank is under pressure for the second day in a row. Yesterday, remember, the banks underperformed on the back of the RBI new norms. But today you are seeing softness in ICICI Bank. Axis Bank has opened up flat, but otherwise the Nifty banking is moving largely in step with the frontliners. Good start. The Nifty is up over 100 points, up 0.5%. Mid-caps outperforming yet again with the advanced decline ratio at 5:1.
CEAT is a stock of the morning. The EBITDA number jumped up by close to 50%. The margins expanded close to around 250 basis points. So that's the stock of the morning. CEAT is up close to around 10% as we speak. Big up move out there. Bandhan Bank, one of those big underperformers. But the past quarter's numbers, the street seems to have liked it. The reason is the sharp decline in provisions and the NIMs as well, popping up by close to around 30 basis points on a sequential basis. The other big movers, Greenply, just take a look at that stock. Big up move out there. The absolute EBITDA number was up 37%. The margins expanded by close to around 100 basis points in a challenging environment. So that stock, just take a look at that. Big 12% move on that name. Star Health, well, you have the net premium that was up close to around 14%. The combined ratio as well came down to around 95% in comparison to around 99% on a year-on-year basis. Stock up close to 10%. So many good earnings reactions is what you've seen. Garden Reach, I think Rima pointed that out. EBITDA number up close to 60%. Margins expanded by 330 basis points. Stock up 10%. numerous 8 to 10% winners actually in reaction to its number. Skipper, the EBITDA number was up by close to around 40%. The FY27 number, maybe the outlook is a little weaker than what the street would have liked, but that stock as well has popped up. Maybe the stock has already factored in any kind of disappointment, so that is well moving on very large volumes. NV, photovoltaic, will chat with the management soon, but the margins holding steady, the absolute EBITDA number up more than 50%. The street likes that. Canara HSBC Life, we just had the management. They sounded optimistic about the future. So that stock as well, good returns on that one. Big up move out there. And Piccadilly Agro, the EBITDA number is up by close to 14%, but they've approved the demerger of the sugar business. So let's see whether or not we're getting a reaction on that particular name as well. So that one comes up for you on the screen. That's up close to around 2.5%. 5-star, I think Rima pointed it out. AUM up more than 10%. Street likes it. While Piramal Pharma, I think the EBITDA number came down by close to around 18%. The margins on a year-on-year basis a little bit softer. So I think both those two stocks a little under the weather. 5-star, beg your pardon, that stock is lower. Piramal Pharma as well, mildly lower. All in all, plenty of good earnings reactions. You like what you see when the broader markets, you get earnings surprises. And I think that's evident today.
Star Health is the other one, moving well, 9% higher in trade.
Okay, well, over 24,076. It's about 1/3% higher. The Nifty Bank is coming up on your screens, and I think that is just about slipped into the red, the Nifty Bank. And broader markets, though, are doing much better as we started the session. Maruti with a 4% pop. So, that's the other one. And I was talking about, there's Garden Reach, but look at Cochin, look at Mazgaon and those stocks, the shipbuilders. Usually, when there's a move which appears, it's perhaps, it shows up in all three. And I guess that's what we're seeing right now.
Just one more, Prashant. Yeah. Vedanta today is going to be in focus because of numerous reasons. Today, it's the come date. That is the last day to buy it if you want to be part of the demerger. So that's point number one. It'll be the last time, hopefully, that they'll be reporting numbers as a consolidated entity. We have seen various mergers and demergers, but today it'll be reporting as one particular entity. And the final reason for the volatility will be all the FNO contracts will expire today, because tomorrow you'll be having the stock that will be trading X of all the aluminum businesses. You'll only be having Vedanta Limited, which is effectively the holding company of Hindustan Zinc that will get traded. So expect a lot of volatility on this particular name with high volumes as well.
Yeah, and some price discovery, etc.
Tomorrow.
In tomorrow's session, when that the entity X, some of the other businesses comes through. So we of course explained it extensively over the last many days, actually last many weeks. Well, Raman Johar is with us, MD and Head of Equities at Access Capital. Raman, good morning. Great to have you with us here. Thanks for joining us. Prashant this side. Raman, what are you telling clients? What's the mood like? In a bit of a flux with where we find ourselves. Oil prices are high. But equity markets, if the energy pinch is short-lived, markets don't kind of factor that in a permanent way. And I guess that is what we're seeing. Markets around the world are holding up very well. Your thoughts, Raman?
Morning, Prashant. Thanks for having me. Good day to have this conversation as well after a couple of days of sort of a shakeout in the market. So first up, recovery from the lows in the market has been sharper than what many people anticipated. So we are up about 8% on Nifty. We are up 15 to 18% on the broader market indices. So that's something which tells you that there is a lot of strength in the broader market. There is a lot of strength in the market. Partly this was triggered by short covering. So when we started the April derivative series, when we started the April derivative series, we started with a very, very high open interest base, and that was driven by predominantly aggressive shorts in the market. As the month progressed, a lot of those have come off, and that was part of the trigger for the move. But more importantly, as you also put, there is expectation of some normalization in macros, which the market has been factoring in. My worry now is that there have been multiple spate of false starts to that. We saw various deadlines come and go. We saw crude touching 90, and now it's back to around 110. So that is something that is making the markets nervous until the time, given that the markets have been burned a couple of times in the Indian context. Till the time we see something more concrete, we might see a little bit capping on the range. The other thing is April saw about 1.2% EPS downgrades after a long time. So in the last few months, the downgrades has sort of stopped. And this was right now driven by a narrower universe. But as the inflationary pressure, as the supply chain disruption, they start hurting over the next few months, there will be a broader and consumer-led downgrade cycle which might come through as well. So those are kind of things that people need to keep watching for. As I said, expect markets to be a little bit range-bound till we have clarity. 23,000 on the lower side, 24.5 on the upper side. But let me end this on a more constructive note. Our view entering into the year, into the calendar year, was that we will see the Indian EPS downgrade cycle normalizing soon. This recovery, we still believe is pretty much on the cards. We just believe that the recovery is delayed and not recovery denied.
But the range that you see, Raman, hi, Rima here, is 23,000 to 24,500 on the way up, which doesn't leave too much upside. So this range that you're talking about is for the next 3 months, 6 months, because we still have a month of the earnings season to go, and many of the big numbers are still awaited. So the EPS downgrades may pick up, and it will continue, perhaps, in Q1 FY27 as the war lingers on. So give us a little more color on this range-bound view of yours. And then if the upside is capped, how does one make money? What is the advice to clients?
Sure. So it's not, given that so many things are moving on the macro side, this is not a very long-term view. This is something in the immediate term. Till the time, as I said, market has been burned by a couple of false starts on this entire normalization process. So till the time there is more clarity, till the time we see a sustained downtick on the crude, I think the cap on the market will sort of appear. What we are seeing is that there has been a reasonable amount of churn in the market. There has been reallocation to various sectors. So we have been constructive on financials for that matter. That call has been holding up well. The earnings which have come out in banks especially, as well as lenders, NBFCs included, have performed well on all three vectors. So we have growth, which has done well. So loan growth is very strong across most banks and lenders. Margins have been largely benign. And even the outlook that people have given so far, both on asset quality. We entered the earnings cycle on a very benign asset quality benchmark. And even from there, I think asset quality has been coming better. So lenders remain a key area of focus or a key area of overweight for us. We also like real estate. So what we believe, both from commentary from various real estate players as well as our own channel checks on the ground, the entire construction piece in India has been doing reasonably well. Obviously, there is a little bit concern about worker migration in recent months, but so far it hasn't really started impacting the intensity of construction. So, be it real estate, which is a sector which is still beaten down, or be it some of the ancillary plays, including, stuff like cement, all those could be areas which have not done very well in recent past and could be areas of focus. So even if market remains range bound, and we've seen about 18 to 20 months of market remaining range bound, there are pockets where at different points there is sector rotation going on, there is money moving in, and those are the kind of bottom-up ideas that clients need to continue looking at.
When we last spoke to you during the conference, you had spoken about the quality and the seriousness of the FI interest in the Indian market, but the numbers are telling a completely different picture. So in the last 2 months, what is, when you speak to the FI clients and try and convince them to invest in the Indian market, I'm sure there is a lot of pushback. Look at the rupee, look at the earnings downgrade, anti-AI story, etc. But when do you expect that to change?
Sure. So if you break down the FI story into 2 buckets, one part is the allocation to emerging markets. And this is where, as the year began, so January, I think, saw $19-20 billion worth of inflows into emerging market ETFs. But India at that time was struggling with, obviously, the AI disruption. But remember that at that time, the trade deals had not come through. So India, despite the EM bucket seeing a $19-20 billion inflow, India saw $3-3.5 billion kind of an outflow. That started to normalize once the EU and US deals were in place. So February, we did see some interest coming back. We saw positive flows into the market from foreigners for a while, but that again got disrupted by the time we came to February end, because that's when the war broke out. And that's when sort of a double whammy happened for the Indian markets. One, emerging market flow itself turned. And then even if you go back to Feb, even though we did see inflows come through for a large period of Feb, we did not get those flows in conjunction to what our weights in various indices are. So India was still a net loser of capital, just that the overall emerging market flows sort of helped all boats rise in the tide. Now we are getting to a stage where, so in April, over the last 5-6 days, we have started seeing a small inflow in India dedicated ETFs, and it's small right now, I think close to $350-400 million. But what it signifies is that there could be a change in trend which is coming up. This uptick is relevant because the last time these ETFs started getting inflow was all the way back in July last year. So that is one part which is encouraging. Second, again, emerging market flow has turned. So the mothership has sort of will support the overall construct as well. So having said that, I mean, we saw the kind of flows that we saw in March. I don't think we will see that kind of a pressure again. Flows should be a lot more benign. But for a meaningful uptick, for active fund managers who start coming in, we will need to deliver growth. India has been a growth market. Our competition, which is some of the North Asian markets, they have been delivering very well on EPS growth. So till the time that EPS growth starts cementing in, sustainable, active allocation to India will remain under pressure.
All right. Hi, Raman. Good morning. Good to see you. Let's talk about a couple of sectors then. India has outperformed in comparison to some of our peers, and the sector within India that's underperformed has been tech because of the so-called missing AI link. Post this recent de-rating and the sharp underperformance that we've seen, what's your view on tech? You know, one would argue that the street is actually being over-pessimistic, but the other argument is with very good reason, because growth's going to be absent. What's your position?
Yeah, well put. So this is something which I think everyone is tracking very closely. And unfortunately, the sector is caught in the perfect storm. So we had, over the last couple of quarters at least, this macro and long-term headwind of what the terminal value should be, how much of deflationary pressure will these new technologies put in, and so on and so forth. So these were all macro sort of, I mean, at the risk of sounding a little too drastic, they were sort of existentialist challenges on the macro in the long term. This quarter, we also saw short-term pressures because there is clear evidence both from numbers as well as commentary that the discretionary spend seems to be under pressure, and which is why I said that this is a perfect storm where short-term and long-term both outlooks have been impacted. So, I mean, incidentally, IT now, after this de-rating, is one of the few sectors where both foreign and domestic institutions are reasonably underweight. So in that sense, you're right to say that there is an argument to at least think if the de-rating is now complete. But at the same time, I would imagine that this will not change in a hurry, especially given that there is no clarity yet on how the long-term prospects of this will play out. So it's a sector down in the dumps. It's de-rated a lot, but I don't think the re-rating will happen in a hurry.
Raman, great conversation. Thank you very much for joining in.
Thank you.
Thank you. Look forward to the next one. Moving on now, AWL Agri reported a good set of Q4 numbers. Profits were up 53%, revenue growth of about 17% year on year. We have with us Shrikant Kankare, Managing Director and CEO of AWL Agri Business. Thank you very much for joining in. Now, we've seen a sharp edible oil EBIT recovery. So you've clearly benefited from, oil price rise and the fact that you were sitting on lower priced inventory. Can you give us a sense of the inventory position in Q1? How much of that will benefit the edible oil margins in Q1, and what is the guidance on this particular segment?
I think thank you very much, first of all, for hosting me on your morning show. Yes, we had a very good set of numbers coming in for the Q4 with overall 14% of volume growth led by the edible oil segment. To answer your question particularly, yes, this quarter saw basically demand coming in from all the quarters, whether it is a rural or urban. And particularly, we did saw a pent-up demand in the month of March after the Iran conflict started. So this continued till end of the March. So of course, in the Q1, that is for the first month, we are seeing a little bit of sluggishness in the demand because a lot of inventories got accumulated by the trade in the month of March, which is now getting liquidated in April. But overall, I think Q1 should be reasonably good. It's not a very high quarter for staple consumption as such in India, but we are hopeful that we should be able to continue and deliver better than the Q1 of last year.
Okay. And EBIT margins for edible oil were at 2% in Q4. Given the seasonality, what is the number? And also, if you could give us the volume growth for FY27.
Yeah, FY27, I think I'll first talk about the volume growth, and this is what we have been saying for quite some time. Edible oil should keep growing at a mid-single digit kind of number. Food remains a focus area for us, and we would certainly want it to grow double digit, though we couldn't do this particular year. And therefore, when we look at a blended growth for the company for FY27, I think we should end up having growth anywhere between mid-single digit to a little bit of high single digit growth next year. On the margins, I think on a per ton basis, we have been able to deliver what we have been saying. Overall margin of close to 12,000 rupees a ton on a gross margin basis and EBITDA of 3,500 tons. We have been able to deliver that. Next year, of course, consolidation remains one of the focus area for the company. We should be able to deliver little better than this. And led by the volume growth, I hope we should be able to deliver a consolidated better number as compared to 26 in 27.
The market share, since you are expecting a pickup in volumes in FY27 versus FY26, I think your guidance is for mid to slightly higher single-digit growth. Last year, you did a 4% volume growth. Do you anticipate a pickup in your market share? What is the target?
See, market share, of course, is a function of how the other players are also doing, and in particularly or the private labels and other big players. But yes, we are hopeful that we should consolidate market share. We consolidated market share this year as well. And assuming that we grow in a mid-single digit as far as the edible oil is concerned next year and market usually grow in the range of 2 to 3%, I think we should be able to consolidate market share anywhere between 50 to 70 basis points.
All right. So, Mr. Srikanth, you're saying that market share will continue to improve from year on. I think the last reported number we have is 18.1%. So you're expecting for this year, it goes up by another 100 basis points?
Close to 50 to 60 basis points is what we are saying. In the Q4, actually, our market share went up. So we try to monitor market share on a quarter basis as well as a financial year basis. We are hopeful that we should be able to deliver this.
All right. What about distribution expansion, your direct reach, if you could update us on that front, and also your rural town coverage?
Yeah. Distribution remains a focus area for us because what we have been saying is the next phase of the growth for the company will come from the distribution-led growth kind of things which we are looking at. Today, we reach close to more than 900,000 outlets directly. Indirect plus direct is close to 2.5 million outlets. But this 2.5 million is still close to 50% of the entire universe of the outlet which is selling edible oil and the staples. So there is quite a big headroom that we have to grow, and we are consistently working on that. And our entire focus basically on the rural distribution where we are working. Now, as we speak now, we are reaching to close to 60,000 plus towns. 55,000 towns of that are getting built every 3 months. So this 60,000, we are hoping that should go to 75,000 towns in the next year. Plus, of course, the kind of outlet addition which right now at 900,000 outlets. So we should be able to cross that 1 million outlets by the mid of the next year.
All right, we'll leave it there, sir. Thank you very much. Good luck to you, and always great speaking with you on the business outlook going forward. We'll take a break. We've got other managements joining us. MV reported numbers as well, and we've got the management of MV Photovoltaic with us on the quarterly performance and the outlook going forward. Stay tuned.
Welcome back. Markets are holding strong with a gain of close to around 100 points, but the Nifty Bank is not playing ball yet again. That's trading with a bit of a negative bias, explains why the Nifty is not able to get up and going. But from the broader markets, plenty of stocks are doing a jig of their own. One such stock is MV Photovoltaic, reported a strong set of numbers in Q4, and the stock is up close to around 8.5%. In the last 1 month, it's up close to around 30% or thereabouts. We have with us Mr. Suhas Donti, the whole-time director, president and CEO of MV Photovoltaic, that joins in. Hi, Suhas. Good morning. Good to see you, and congratulations on a good showing. Well, the street is quite optimistic on your numbers going ahead, and also they highlight that the stock is trading at a bit of a discount in comparison to some of its peers. One such note that came in from JM Financial earlier this month said that they are expecting the EBITDA number to grow at a CAGR of close to around 60%, which means they believe your EBITDA number from around 720 crores that you reported last year, that's FY25, should move closer to around 3,000 crores in FY28. You're already at around 1,700 crores. Do you think 3,000 crores is possible in FY28?
Yeah, hi. Thank you very much for having me here. It's always a pleasure. So absolutely, I mean, right now, looking at our performance in the FY26, we've backed up with our expansion in capacity from 5 gigawatt of module to 10.3 gigawatt of module, which shows the current run rate of our EBITDA at 571 crores in Q4 itself. So with that run rate, I think we're going to be achieving it far ahead if you just analyze this run rate.
All right. So you're saying the 3,000 crores run rate could come in maybe sometime in FY27 itself?
I think what I'd say is that the run rate of 571 crores near that is something that we are confident to maintain. So you can analyze that to around 22,000 to 2,200 to 2,400.
2,200 to 2,400 crores for FY27. Is that correct?
Correct. We're very confident to achieve better than that.
And 3,000 crores will be there for the taking in FY28.
Yes.
Got it. All right. Let's focus on a couple of factors then. So you're assuming margins stay in this vicinity of around 33 to 35%?
Yeah. So the margin has been strong with our cell production, our backward integration. We have our TOPCon cell line where the margin has remained strong at that level. The mix of module capacity, where module capacity has grown from 6 gigawatt to 10 gigawatt by 2026. So with that mix, the nuances are it's in line with that.
Okay.
So the focus must be on the EBITDA absolute EBITDA and EBITDA per unit rather than the percentage of EBITDA.
All right. Suhas, if I got it correct, you were the first to be listed in the ALMM list for both TOPCon modules as well as cells. Could you tell us what is the additional demand you're expecting, the revenue you're expecting in FY27 due to this?
Yeah. With us being ahead in technology as well as being a player with an experience of over 20 years in module manufacturing, we have a strong credibility in our customer base. So with that, you can see our strong order book where we have 9.4 gigawatt of order book. And in fact, just Q4 inflow was 1.27 gigawatt. So order books have been healthy and strong.
See, you said that the focus is on the EBITDA per unit and not the EBITDA margins. I think for FY26, your blended EBITDA was about 5.78 rupees per unit. Is that the correct number? It went up in FY26. What is the expected number, Suhas, for FY27?
So the blended EBITDA is again a calculation of your cell and module and your module mix, or rather a DCR and non-DCR mix, which we usually don't give out these numbers. I'd like to stick to the narrative that the EBITDA per watt peak is something that's remains strong, but rather on a market perspective should look at the absolute EBITDA that is growing. Like we've grown 58% even quarter on quarter, and we've tripled our EBITDA over the last 1 year.
Suhas, hi, good morning. To use a Hindi phrase, right, to describe the bears on this space, and I want you to push back, right, because there are lots of people who say that to use that phrase, "Char din ki chandni hai, phir whatever." Is that where the industry is? And I'll tell you why, right? I mean, there are analysts who say that they take a total profit pool, which they say perhaps the size is about by 2036 about say 1 lakh crore, say a 10-15% margin that gets you to between a 10 to 15,000 odd crore in terms of profit pool at max. And then you got players, all the big players there. Adani is there, and Tata's is there. Reliance, of course, will come. There is, Premier and all the others. So then heightened competition, and that's the reason why many have stayed away. Many institutions have stayed away from many of the players. I'm talking about, funds, etc. How would you, what's the perspective you'd like to sort of, bring against this argument, which people make?
Yeah, rather than beating a narrative, the way I see it is we've shown consistent performance over the past many years. We're not a company that has been incorporated very recently, but we've been around in solar module manufacturing, cell manufacturing, this ecosystem for the last over 20 years now. And with that kind of a growth and conviction that we have continuously...
Suhas, this is not about MV. Suhas, this is not about envy. What I'm saying is that the point which people make on the other side is that this is a supernormal great time, and then suddenly there is a cliff. That is all for the industry.
So as I'm saying, there are many cycles and challenges that the company at MV we have seen in this industry, right? We have seen times where there was ALMM, there was no ALMM, there was BCD, no BCD, no tariff. Markets were moving from one region to the other, yet, we've been resilient with our, delivering our profits, with our EBITDA, and with growing and bringing in the right technology to match the demand that there is. So our conviction is primarily on the capacity that we are building and being very mindful of the addition of capacity we're doing from the demand perspective, as well as on the technological front. How do we build the capability that is demanded or required by the customers that are buying on the other side.
Okay, all right. Yeah. All right, so let's try to clear out one more query. What if Indian exporters, they lose the US market and they redirect capacity domestically? There could be some pricing pressure in India. Are you seeing that play out in any kind of tender pricing so far?
Just on an MV perspective, we have zero exposure to export.
Got that.
Industry perspective, if you look at it over the last 6 months, if you analyze the exports, there has been hardly negligible exports compared to the capacity or the demand that we have in India. So I don't see any sort of a pressure that is coming in from that. Neither have I seen so far, or I expect to see in the future either.
All right.
Okay. All right, very quickly, some of our peers are moving into inverters, BESS, electrolyzers as well. Do you have any kind of diversification plans?
So we are very much committed to increase the value chain of solar manufacturing. That is fully integrate ourselves, looking into getting into this medium term, getting into ingots and wafers. But when it comes to the other products that are going to be which will add on to the solar value chain, that is something that we are, we do evaluate all opportunities that come to that are there. And as of now, we don't have anything that we like to comment on that.
Got it. So thanks very much for joining us, and we wish you all the best of luck to adapt, change, and of course reinvent. As you pointed out, many regimes have come and gone, and you're not a new company. You're not You've been around for some time. Thank you very much. We'll take a break. We are back in just a bit. But before we take a break, I want to highlight one story that we put out yesterday. The maker of India's most iconic biscuits, Parle G, is considering going public. Sources tell CNBC-TV18 that Parle Products has initiated conversations with at least 5 investment banks for a potential IPO. Rachna's got more details here. She broke that story. Rachna, take it away.
Well, India's most beloved biscuit brand may be heading to the Lal Street. Sources tell CNBC-TV18 that Parle Products, the maker of Parle G, has initiated conversations with at least 5 investment banks. 3 of those include Kotak Mahindra Bank, Axis and JM Financial for a potential listing. Now, the talks are expected to move forward somewhere in mid-May when the proposals reach the company again. Now, here's what makes this transaction interesting. From what we learned from our sources is that if it moves forward, it would be a complete secondary transaction. No fresh capital infusion in the company, no public money will be raised, but instead the promoters will be cutting down their stake. Now, this has been a 100% promoter-held entity ever since it was founded in 1950. We did reach out to Parle Products and they said that nothing as of now, but these are the ideas that they keep getting from their advisors. So they keep getting ideas from advisors to create value, and they assess these ideas to enable growth, which sounds like a very carefully worded non-denial to what we were seeking in comment. Now, just to put the scale of this transaction in perspective, Parle Products reported a revenue of about 16,000 crore rupees in FY25. Its closest listed rival is Britannia Industries that reported just under 18,000 crore rupees. So a Parle listing would put both of India's biscuit giants on the same public stage for the first time. Now, Parle G alone has been in every Indian household for decades and was even ranked as #1 biscuit in 2020 by Nielsen. But the portfolio also includes hide and seek, crackjack, Monaco and other products. So this will be a big one for us to follow also. So we will keep an eye out for more details and updates.
Okay, well, Parle IPO, right? I mean, markets will pick up at some point. The primary market, they're a little down and out. But this is, of course, going to be one of the big ones to watch out for. Rachna, thanks very much for that. Well, back to the earnings list. And Motherson Sumi reported a mixed set of fourth quarter numbers. Revenue growth remains healthy on the back of strong auto volumes. Margins, though, have contracted. Anurag Gehlot, the CEO at the company, is with us. Anurag, good morning. Great to have you with us here on CNBC-TV18 this morning. Appreciate your time. Prashant this side. Let's just start with that margins question, if you'd allow it, Anurag. 8.2%. Was almost 11% same quarter last year. How much was this purely copper-led? And how much of this copper price increase were you able to pass on? There's also, of course, the unfavorable forex mix. What should we expect? How should all of this shape up into the first quarter, the quarter that we are in? Go on.
Yeah, good morning, Prashant. Thanks for taking us on CNBC-TV18. In terms of margins, the profitability from the existing business remains stable. There has been no underlying pressure on margins, excluding the pass-through impact on account of the higher copper prices. There is a significant increase in the copper prices quarter on quarter, approximately 18%, which will be offset in the next 3 to 6 months as per the contractual terms with the customer. And if you review our annual performance, it is evident that the substantial portion of the cost impact from earlier quarter has already been passed on. So overall performance continues to be strong, and the margin impact from copper price fluctuations are temporary in nature at this moment and does not affect the underlying strength of the business. Coming back, that we are a ROS-focused company and have consistently delivering strong year-on-year ROS, reflecting the robustness of our margin profile. The copper impact of to the EBITDA level is approximately, if I talk about in the numbers, it's around 2 to 2.5%. And I think, as I said, that it's a back-to-back arrangement for the forex as well as for the copper. So I think it is as of now, it's a temporary in nature, and we should see there is an improvement as we move on in the this financial year.
Let's just assume, Anurag, for a bit that it's where we are at copper prices and currency crosses, etc. They're all there, right? They hold at these levels. A steady state, of course, it won't be, but let's just assume for a minute. What would, if I were to ask you to guide the market for 27, where would you be in terms of EBITDA margins?
See, there is a very difficult for anyone to predict how the copper prices will be. But as I suggested that, the copper prices, which are on the higher side at this moment, and we do have this back-to-back arrangement with the customers. So if there is going to be a fluctuation into these, then obviously it will be offset into the next quarter, and we'll start seeing improvement over there. So at this point in time, as no one can predict it, it's very difficult for us to say that how this copper will take place. But the idea is that we have the customer contracts in place, and which is backing us in case of there are any fluctuations there, then that can be taken care of.
So you're saying that copper prices impacted your margins by 200 to 250 basis points in Q4, but you have a complete pass-through arrangement with your clients, and therefore Q1 margins should improve, right? It was just so Q1 margin should be better. It should reverse.
Yes, if the copper prices, if they are going to continue to be on the higher side, then there will not be a big improvement. But yes, if there will be a fluctuation into the copper prices, yes, definitely that will come to us.
Sorry, so Q1 margins should be higher, right? Because if prices stay where they are, you've already taken the impact of it in Q4, and now you're going to benefit with the pass-through.
Yes, because it's a lag of quarter with the majority of the customers. So if the copper prices remains on the higher side, then the impact will come into the next quarter only. So you have to wait and watch for that.
All right. What about the profitability of your greenfield plants? I believe it improved in Q4. What was the EBITDA margin there? And when does that turn around? Because that was also a drag on your margins.
Yes, we are not giving a breakup of the margins to the greenfield, but as you must have seen that we have done a 440 crores of sales revenue from the greenfield, and they are coming to the close of around 70 to 80%. And obviously, in this sales revenue, few of the projects has gone delayed from the customer end itself, but now they are into the ramping up stage and volumes are growing. So we will see a good turnaround of the margins into the greenfield as well.
All right. Hi, Anurag. Good to see you. When your EV contribution, I think, is holding at around 8.5%. You could correct me on that number. How do you think we scale this business, say, by the end of this fiscal? And also give us an insight in terms of margins. How does it compare with the ICE wiring harness business?
Okay. So, as you rightly said, it's around 8.56%, the EV share into our Q4 revenues. EV is more dependent on customer choices. If customer is looking for the EV vehicles, more traction towards that, then obviously it will be selling more. As MSWIL, we are supplying to all the powertrains in the country, whether it's ICE, EV, hybrid, or CNG. The most important point is we are a future-ready organization. We are ready with our capacities. As the EV will be picked up, we are ready to manufacture and supply to these OEMs. EV typically do not impact wiring harness business margin negatively. EV typically increases the wiring harness complexity and content per vehicle, particularly due to high voltage harness, charging systems, and advanced electronics. So it is not giving any impact on the margin, but just more of a complex thing. And in short, I can say that hybrid and EV platform are content accretive for MSWIL, rather to put like this.
Anurag, we leave the conversation here. Thank you very much for joining in. Castrol India also reported the Q4 numbers. The company saw single-digit revenue and single-digit profit growth in the quarter. The management said that the business remains strong while the external environment remains a bit volatile. We have with us Saugata Basure, whole-time director and the interim CEO of the company, now joining in. Thank you very much for joining in. You have highlighted how the emerging external headwinds at the end of the quarter, particularly related to the forex and rising raw materials on account of the geopolitical tensions. Now, we've seen a little bit of a margin correction in Q1, 21.4% at the EBITDA level. What can you guide or indicate for margins going ahead, given these headwinds?
Hi, good morning, and thank you for having me on the show. I just want to step back and just talk about the Q1 performance. Strong volume growth, almost 2 times that of the market growth. So we gained share, sequential volume growth as well. And what we have seen is growth coming through from our ramp up of distribution deep into rural India as well as in urban centers. So premium products are growing as well. Our EBITDA margins remain within the range that we have guided, and that's in the range of 21 to 24. We see emerging headwinds in terms of currency and raw material inflation, which is happening on account of the conflict in the Middle East. I think we are seized upon that. We have taken various actions to manage the near-term volatility, which will come through on raw material. Overall, we feel pretty good in terms of execution of our strategy, because inherently there is demand coming through in the market, and we stand ready to participate in that.
So volume growth, you said, was twice of that of the industry. What is the expected volume growth going ahead for FY27 or the first half of FY27 if you have the visibility? And did you take any price hikes in the quarter?
We took towards the end of the quarter a price increase, and you can see that our revenue growth is at 9%, driven by an 8% volume growth. Part of it is on account of pricing, but that just came through towards the end of the quarter. But a lot of it is on account of our premium product mix expanding, right? The industry forecast in this category for the full year remains at a secular level of around 4%. And we have now had more than 12 quarters we have been growing ahead of that market and therefore gaining share.
So, Gata, morning. We will perhaps see some fuel price hikes, right? Eventually, after these elections are over. Is that do you expect consumers to adjust? Does that happen if they are? Typically, we don't see very large fuel price increases. The adjustment required is large, but perhaps not at the consumer level. Hopefully not. But does that make have a difference, a near-term blip, some impact?
Look, I can't predict the fuel price increase, as you can imagine. We are not in that business. But what I will say is that we step back and look at the performance of Castrol over cycles. We have been here for a very long time, right? So we have ridden these cycles. What works in our favor is a very robust distribution infrastructure deep into the country. We are at about 150,000 outlets, direct reach and indirect in rural, another 40,000. So it's really world class. And a portfolio of brands which operate across price segments, and that allows us to participate across every segment, be it cars, bikes, commercial vehicle. So we believe, depending on which way consumers were to adjust, basis the environment that comes through in the rest of the year, we would have products which would cater to their requirements.
You know, the other big kind of sort of talking point, Saugata, has been this push away from dependence on oil because of the shock that we've had, right? Actually, just this morning, as we are talking, the government has amended the Motor Vehicles Act, including talking about much higher levels of blending, E20. They're putting in, E85 and E100 and things like that. I mean, it just come through. I was looking at it. And of course, at the same time, also pushing electrification in a big way. I mean, these are all trends. These are big trends and it'll take time to play out. Maybe there's some urgency now because what we're seeing. Does that go fundamentally in the opposite direction of where Castrol is positioned right now?
It actually plays into the position that we've taken now for several years. So our view always has been that we will participate across the ecosystem of mobility. There is a movement towards low carbon mobility. We think there are multiple pathways to that. There are blended fuel, as you've called out. There are powertrains or vehicles which are now fired by gas, LPG, LNG, CNG. And of course, the conventional ICE engines are also becoming much more efficient. All of that is something that sits in squarely in our scenarios that we have planned for. We stand ready with products which are already in the market. For example, which are E20 compatible. We introduced them a couple of years back. So whichever policy decision the government takes to drive resilience into the mobility ecosystem, we will have a portfolio of products that are available in the market to serve our consumers. So it's something that we are quite prepared to participate in.
Okay, all right. Saugata, in the last quarter, you had talked about products being developed with respect to data center cooling environment. And you were also in talks with various hyperscalers, data center providers as well for some partnerships. Could you provide us with some insights Any contracts have been signed? Any you expect to get closed out in the coming quarters?
We are in active conversations, and I can confirm to you that there are trials that are operating in India with various hyperscalers. The products that we have brought into the country, which are being tested out, are the same products that we sell in some of our global markets, where the data center market has moved a few years ahead. So, as and when the sector takes off, we will be participating in that. At this stage, it's too early for us to give a guidance in terms of how much of that is going to happen in the next couple of quarters. A lot of it depends on how some of these infrastructure investments hit the ground and are scaled up.
But liquid cooling as a technology is really taken off, kind of well established and now, well accepted globally?
Well, that technology or the cooling ecosystem itself is also evolving because of the pace at which data centers are being scaled up. There are immersion cooling systems which are used. There are also direct-to-chip cooling systems which are being used. And the products are somewhat different, and we have those products. We are in constant conversation, not only with the hyperscalers, but also people who are the OEMs who manufacture some of those chips and design the cooling systems.
Okay. Just one final word. Any conversation now that Stonepeak has made an open offer for the company? Is there any conversation surrounding delisting, ownership change?
Well, that's something which the shareholders have to decide. And as you can imagine, this transaction is subject to regulatory approvals across the world. And as and when that closes, then I think they would do what is required to comply with Indian regulations.
We'll leave the conversation here. Thank you very much for joining in.
Thank you. Thank you.
Get into a break. On the other side, Manisha will talk about commodities. Stay tuned. Welcome back. Markets holding out well, 24,200 on the Nifty. But what about commodities? Manisha is now joining in with a complete roundup.
Well, thank you for that. I'll start with the crude oil prices, where we have seen 3% of gains come in for the overnight markets. Therein, the US and Iran peace talks still have not picked up, and the market's really looking at on an everyday headline therein. Apart from that, US could sanction China and other countries which are paying fees to Iran to secure transit from Strait of Hormuz. That's yet another thing that the street will keep an eye on. But the big story, of course, overnight has been UAE leaving OPEC. I'll tell you why it's a big deal, because UAE is an important, or has been an important ally for the OPEC countries for a very long time. So UAE, as of now, has said that it would leave OPEC and OPEC Plus as well from 1st of May, which is Friday. UAE has been an OPEC member since 1967, and OPEC was, by the way, formed in 1960. So OPEC has been one of the earlier members that UAE has been an earlier member from OPEC therein. Well, UAE actually has been saying a lot of things. For one, they say that the cartel sets limits and wants to try on prices as well, while UAE does not want to be a part of that. UAE also, in various statements that have been given to media, said that they have not consulted other countries before announcing this decision. UAE also does not want to work with OPEC production limits or its sense on trying to hold prices as well. What UAE basically is looking for is more flexibility and no collective obligations that OPEC members have to adhere to. Also, there have been years of friction between UAE and Saudi, and this is not the first time that we've heard this. This is the first time that has been done, but there have been statements and thought process that has been working towards this. The other members that have left OPEC in the recent times has been Qatar, which left in 2019, Angola very recently in 2024. But the reason UAE is big news is because UAE departure will impact 12% of the OPEC output therein. I also want to take you through on what really OPEC members produce or have done in 2025. So Saudi Arabia, of course, has been the biggest one when it comes to production at around 8.96 million barrels per day. Iran stands at 3.8. Iraq also is on the higher side. UAE, in the meanwhile, is 2.92 million barrels per day. And the other of the members, as you can see, do less than 1 million barrels per day as well. Venezuela, Algeria, you have Congo, Gabon, Guinea. They do less than 1 million barrels per day. So the major chunk really comes in for the top 3 or 4 countries, which include Saudi Arabia, Iraq, Iran, UAE, Kuwait, etc. And now you have the OPEC Plus, which has been working together as a cartel to ensure that the production is curtailed, and the prices in that sense have seen an increase. Within this, Russia, of course, is the major producer, 9.1 million barrels per day. And then you have a very sharp decline, Mexico, Kazakhstan and Oman doing around 1 to 1.5 million barrels per day. And less than 500,000 barrels is what Azerbaijan, Malaysia and Bahrain do. But even more interesting is the fact that it is the non-OPEC members which have seen a very sharp increase, and UAE as a country perhaps would be joining this list from 1st of May. Within the non-OPEC members who do very big volumes is US at 13.5. You have Canada inching up at 5.9. Brazil in the last few years have gained as well. 4.5 million barrels per day is what they do. And then, of course, UAE will add to this list almost with nearly 4 million barrels per day.
Manisha, thank you very much for that. It's an interesting story. It's a big global story, which, of course, is top of the list this morning. We'll take a break. We are back, and our special segment, Indianomics, comes up. Lata speaks to 4 infotech security experts about the challenges posed by Mythos AI model to India's financial sector and public sector, public digital infrastructure. Stay tuned. That conversation coming up next. Stay tuned.